Think you're an investing guru, or just betting on luck. Investing is like planting a tree, it grows over time. Gambling, more like throwing seeds in the wind. Learn how to water your money tree and avoid the pitfalls of speculating. 1. Investing, the steady sailor. Imagine investing as a steady sailor navigating the sea. The boat, or your portfolio, moves steadily forward, and you're more concerned about reaching a distant island or retirement than racing the speedboats zooming by. You don't jump into every wave, instead, you chart a course and stick to it, rain or shine. Investing is the disciplined practice of putting money into financial assets, such as stocks, bonds, or mutual funds, with the expectation of generating long-term growth or income. Investors analyze fundamentals, diversify their portfolios, and generally aim for steady returns. Patience and discipline are key. Investing requires a calm demeanor and a long-term perspective. Avoid the emotional pitfalls of fear and greed, which can lead to panic selling or overbuying during market highs. Remember, even the best sailors can't control the wind, but they can adjust their sails. 2. Speculating, the thrill seeker. Speculating is like being a thrill seeker on a roller coaster. You're chasing the highs and bracing for the lows, all while hoping you don't lose your lunch or your savings. It's an adrenaline rush, but one misstep and you're back at the ticket booth, buying another ride. Speculating involves buying and selling assets like stocks or commodities with the aim of making quick profits based on short-term price movements. Speculators often rely on market trends, technical analysis, or even hunches, rather than long-term fundamentals. Caution and self-awareness are crucial. Speculating can be exciting, but it also demands a high tolerance for risk and potential loss. Emotional weaknesses like overconfidence and the fear of missing out or FOMO can lead to reckless decisions. Remember, it's not about how fast you go, but how well you handle the turns. The emotional roller coaster. Fear and greed. Fear can lead to selling investments during downturns, locking in losses, while greed can drive irrational buying in hopes of quick gains, FOMO and herd mentality. Speculators are particularly prone to FOMO and herd mentality, often jumping into hot stocks or trends without proper research. This behavior can lead to buying at peaks and selling at lows, resulting in significant losses. Imagine the market as a theme park, with fear and greed as the mascots. Fear is that guy who makes you second-guess getting on the ride, while greed is the one convincing you to try the extreme version. Neither is a good ride buddy. Self-control and a well-thought-out plan are essential for success in the markets. Whether investing or speculating, understanding and managing emotional responses can help prevent costly mistakes. Stick to your strategy, and don't let the mascots dictate your ride. The key is to understand your goals, risk tolerance, and emotional tendencies. Whether you're a steady sailor or a thrill seeker, keep your emotions in check, plan carefully, and remember, the markets are as much about psychology as they are about finance.